Did you think silver's rally to $32 was organic? That the market was finally discovering price? Think again. While you were celebrating silver's breakout from its decade-long suppression, $847 billion in derivative contracts were being quietly reshuffled behind the scenes. The CFTC position limits that were supposed to prevent manipulation, they've become the manipulation tool itself. Right now, as I speak, there are 1.3 billion ounces of silver being traded on paper for every single ounce that exists in deliverable form. That's not a market, that's a mathematical impossibility disguised as price discovery. And the regulatory body that's supposed to prevent this circus, they just approved new position limits that actually increase the concentration of control in fewer hands. Here's what the mainstream financial media won't tell you. The recent silver rally wasn't killed by profit-taking or technical resistance at $35. It was systematically dismantled by a coordinated effort involving algorithmic trading programs, regulatory capture, and the oldest trick in the manipulation playbook, creating artificial supply through unlimited paper contracts. The receipts are hiding in plain sight. JPMorgan alone holds 133 million ounces of physical silver. That's 20% of the entire COMEX registered inventory. But here's the kicker. Their derivative exposure shows they're net short over 400 million ounces through complex swap arrangements that don't even show up in the traditional commitment of traders. Report: the CFTC knows this. They've known it since the 2008 silver investigation that mysteriously concluded with no enforcement action after 4 years of thorough review. Let me walk you through exactly how this manipulation machine operates, because understanding the 4-stage framework will save you from falling for the same trap that's been sprung on silver investors for the past 15 years. Stage 1, the accumulation delusion. This is where we've been since 2020. Physical silver demand hits record highs. Industrial demand from solar panels alone consumed 140 million ounces in 2023, up 22% from the previous year. The US Mint can't keep up with American Eagle production. Perth Mint admits to having supply challenges for the first time in its history. Every metric that should drive price discovery shows massive shortage. But here's the manipulation. While physical disappears, paper supply explodes. The COMEX expanded silver futures trading by 340% during this period. How? Through a regulatory loophole called hedge exemptions that allows commercial traders to hold unlimited positions as long as they claim they're hedging actual business risk. The problem? These commercial hedges include algorithmic trading funds that have zero connection to actual silver production or consumption. Stage 2, the regulatory trap. This is where we are right now, and it's the most dangerous phase. The CFTC implemented new position limits in May 2024 that sound restrictive but actually consolidate control. The new limits cap speculative long positions at 6,000 contracts per trader. That's 30 million ounces. Sounds reasonable until you realize that commercial exemptions still apply, and these exemptions can be stacked through subsidiary structures. Here's the smoking gun. BlackRock's iShares Silver Trust now controls derivative positions equivalent to 47% of annual global silver mine production, but they qualify for commercial exemptions because they're providing liquidity services. The same exemption applies to the 8 largest bullion banks, who collectively hold short positions exceeding the next 3 years of projected mining output. The trap isn't just in the exemptions, it's in the enforcement. The CFTC's position monitoring system updates only weekly, and the reporting threshold hasn't changed since 1991. A trader can accumulate massive positions on Monday, manipulate prices through Thursday, and liquidate by Friday without ever triggering a position limit violation. Stage 3, the breaking point illusion. This is what happened in September and October 2024. Silver pushed toward $35, breaking through technical resistance levels that had held for over a decade. Retail investors poured in, thinking this was finally the big one. Social media filled with predictions of $50, $100, even $500 silver. But the professionals knew better. The options chain showed massive put interest building at the $35 strike over 180,000 contracts, representing 900 million ounces of silver. That's more than the entire global mining output for 10 months. These weren't hedges by miners protecting downside risk. The timing and size indicated coordinated positioning by entities with the capital to make their bets self-fulfilling. When silver hit $34.86 on October 23rd, the hammer fell. Within 72 hours, algorithmic selling programs dumped the equivalent of 340 million ounces onto the market during Asian trading hours when liquidity was thin. The price collapsed to $29.40 before most US retail traders even knew what hit them. Here's the evidence the CFTC doesn't want you to see. During those 72 hours, open interest in silver futures actually increased by 23,000 contracts, while prices were crashing. That means new short positions were being created at exactly the moment when organic selling should have been closing out existing longs. It's the signature of coordinated manipulation. Stage 4, the transfer mechanism. This is the end game, and it's playing out right now. While retail investors watch their paper profits evaporate, the same entities that engineered the crash began accumulating physical silver at the suppressed prices they created. Import data from the London bullion market shows massive physical flows to private vaults immediately following the October price collapse. The Shanghai Gold Exchange reported unusual silver withdrawals, totaling 47 million ounces in the 2 weeks after the crash, the largest 2-week withdrawal in their history. Someone was converting paper profits into physical metal, while the price was artificially depressed. But here's where the historical mirror becomes crystal clear. This exact pattern played out in 1979 to 1980, when the Hunt brothers attempted to corner the silver market. The establishment response wasn't to let the market find its true clearing price, it was to change the rules mid-game. The COMEX implemented liquidation-only trading that made it impossible to establish new long positions. Fast forward to 2024, and we see the same playbook with modern sophistication. Instead of crude rule changes, we have algorithmic execution programs that can dump hundreds of millions of ounces of paper silver onto the market in minutes. Instead of obvious regulatory interference, we have position limits with built-in exemptions that accomplish the same result while maintaining plausible deniability. The 1980 crash wasn't caused by silver reaching its natural peak. It was engineered to prevent price discovery from revealing the true extent of monetary debasement. Today's manipulation serves the same purpose, preventing silver from exposing the insolvency of a financial system built on $280 trillion in global debt and $1.5 quadrillion in derivatives. Here's the mainstream canary that proves the manipulation is accelerating. Insurance companies are quietly dumping their silver ETF holdings while simultaneously increasing their physical bullion storage. State Street's Spider Silver Trust has seen $3.2 billion in institutional outflows since September, but private vault storage at facilities like Brinks and HSBC has increased by 67 million ounces in the same period. Why would institutional money flee paper silver while accumulating physical? Because they have access to the same regulatory capture intelligence that retail investors never see. They know the position limits are theater. They know the CFTC investigation into silver manipulation that began in 2008 and concluded with no action was designed to run out the statute of limitations, not find the truth. The smoking gun is hiding in the Federal Reserve's H4.1 report, the weekly balance sheet release that shows central bank swap arrangements. Since March 2024, there's been a 340% increase in other securities held in custody for foreign central banks. These other securities include precious metals derivatives that don't get reported in standard commodity data. Translation: foreign central banks are using the Federal Reserve as a middleman to manipulate silver prices through derivative instruments that never appear in public position reports. It's the same mechanism used to suppress gold prices through the London bullion market, but applied to silver with surgical precision. The proof is in the timing. Every silver rally in 2024 was killed during Asian trading hours when US oversight was minimal. The selling always originated from London-based accounts with ties to central banking relationships. And the pattern always repeated within 48-72 hours of silver approaching technically significant price levels. This isn't conspiracy theory, it's documented market manipulation with a paper trail. The Bank for International Settlements quarterly derivatives report shows that precious metals derivatives have grown by 89% since 2020, while physical production has increased by only 3%. That mathematical impossibility can only exist in a rigged system. So what's the action plan? First, understand that paper silver prices are completely disconnected from physical silver value. The real price discovery is happening in premium spreads between paper and physical. American silver eagles are trading at premiums of $8.12 over spot price. That's not a market inefficiency. That's the market trying to tell you the spot price is fake. Second, calculate your allocation based on replacement cost, not current market prices. If it costs $45 to produce an ounce of silver from the ground and deliver it to your door, then anything below $40 is a subsidized gift from the manipulation machine. The manipulators can't maintain artificial prices forever when industrial demand is stripping physical supply. Third, diversify your exposure between physical possession and strategic speculation. Physical silver protects against system collapse, but strategic positions in mining companies with low cash costs can profit from the inevitable price recovery when the manipulation becomes unsustainable. The key insight: silver isn't failing to reach $50 because of market forces. It's being prevented from reaching $50 because $50 silver would expose the fraudulent nature of our entire monetary system. When silver hits $50, it signals that paper currency has lost credibility as a store of value. The establishments cannot allow that signal to be sent. But mathematical reality always wins over regulatory fantasy. There are 8 billion people on Earth and less than 1 billion ounces of silver in investment form. When confidence in paper currencies finally breaks and the $33 trillion US debt suggests it will, the rush to real money will make today's manipulation look like a temporary inconvenience. The only question is, when the wealth transfer accelerates, will you be holding the paper promises or the physical metal? The manipulators are counting on you choosing paper. The receipts show they've been wrong before, and they'll be wrong again. But this time, the stakes are the entire monetary system.